at the 40 or $50,000 level, I would be absolutely shocked if it got down under 40,000. I wouldn't, that would be, I would be almost catastrophic. But even then, Bitcoin would recover. It always does. And so, no, I think that if we do have another drawdown, that Bitcoin would come down to maybe the low 50s and high 40s at absolute most. And that is if we have a correlation to one event where everything sells off and it's just caught up with it.
James Lavish says Bitcoin isn't just another investment, it's a complete shift in how the world understands money. While most people still group Bitcoin with thousands of speculative cryptocurrencies, Lavish argues that this misunderstanding could be the biggest financial mistake of this decade. Because in his view, Bitcoin isn't competing with altcoins, it's competing with the entire global monetary system. As governments continue to print money, debt levels spiral out of control, and traditional safe havens lose their reliability, Lavish believes Bitcoin is quietly emerging as the ultimate store of value. Not because it's trendy, but because it's engineered to survive everything the current system cannot. And here's the real hook. If he's right, then Bitcoin isn't late, it's still early. The question is, are you looking at it the right way, or are you about to miss the biggest financial transition of our time?
Mike has a different view on Bitcoin as well. He believes that Bitcoin is just one of tens of thousands of cryptocurrencies. He understands how it's different than the others, but he believes that everybody sees them as just the same thing and that Bitcoin's the oldest one, it's the most boring one, it's the most expensive one, and that if we get a downturn and all the other cryptos are drawing down towards zero, it's going to drag Bitcoin with it. That's kind of, it's backwards. Bitcoin leads everything in the cryptocurrency world. Bitcoin is the only asset that's completely decentralized, is immutable, has a 21 million coin cap, hard cap, that there will never be any more than that. And being fully distributed, that means it's safe. And so here's where we differ, is that fundamentally, Bitcoin is different from all of those other assets, and that it's uncorrelated to everything right now. You can look at Bitcoin and it's moving at its own pace every single day now. And is it correlated to the net? It has been, and I've spoken about this at length, that it has acted as the tip of the wrist spear for a very long time. And so, and that's been just the reality of the perception around it. But that perception is changing. And as we get more and more large institutions involved in Bitcoin, it will continue to change because it will become, and it is becoming, an asset that is now being recommended for institutions to hold as a separate allocation in each portfolio, much like a gold. And so that's the difference right there. They're not recommending Solana and, XRP and all the other stuff. They're recommending Bitcoin. And so this is the classic adoption phase, and it means it's going to be volatile, and it's going to continue to be volatile as this occurs. But 10,000 would mean that you're talking about a drawdown of yet another 85-90% here, and to me, that's just it. He's looking at it in a completely different lens, and it just makes no sense. There would be so much demand at the 40 or $50,000 level. I would be absolutely shocked if it got down under 40,000. I wouldn't, that would be, I would be almost catastrophic. But even then, Bitcoin would recover. It always does. And so, no, I think that he's wrong, that if we do have another drawdown, that Bitcoin would come down to maybe the low 50s and high 40s at absolute most. And that is if we have a correlation to one event where everything sells off and it's just caught up with it. But it's not going to do that on its own. So we differ in the ultimate big philosophy of the market. I don't believe that the U.S. will allow the U.S. Treasury and the Fed will not allow us to go into a multi-year recession. I just don't believe that. And that's what it would take, a 2, 3, 4, 5-year recession for that to happen, in my opinion, for all these assets. So we differ there. We differ where he thinks that the Fed learned its lesson, that it won't print money again. Of course they will. They have no choice but to. And we differ that Bitcoin is completely separate from every other asset. And so it stands alone. It's not going to be drawn down by other highly risk assets like the or investments like the other cryptocurrencies. I think we need kind of two things. We need a resolution of this conflict in the Middle East, number one, because that's just producing great uncertainty. And the second thing is we need a clear direction of where the Fed is going. And because if we have a resolution and it looks like the economy is going to start roaring along with some sort of productivity miracle from the AI sector, and it doesn't crush so many jobs that the economy it just keeps rolling along, well, we could see a period where the Fed holds rates steady, or even does think about raising them, like we saw the market worried about last week. If that happens, then Bitcoin will keep grinding sideways here for a while, I believe. But if we get a resolution on direction, we get a new Fed chair, likely to be favorable to this administration versus Powell, who is, whether or not he's been political, it's up for debate. But the guy has been belittled by Trump so many times. I'm sure he's not a big fan of him. Uh, so that would be a big difference there. We get a resolution in the Middle East, and we get some direction out of the Fed, and we get a clear direction about who's going to be at the chair. And so once we get Warsh, if he's confirmed, hopefully that uncertainty is taken off the list, and I think those would be pretty good catalysts for the market to start marching forward again, especially in Bitcoin. This has quite honestly been one of the most difficult markets to be invested in my career. And, I've lived through a number of large events, what you would call 100-year events. 1998 long-term capital management collapse, the 1999-2000 tech bubble, 2001 9/11, then the 2008 crisis, the 2020 lockdowns. There've been one after another. Yet this one I hate to say it's different this time. All of them were a little bit different, but this one has just been extremely difficult to navigate. One of the reasons for that is that you've had this run up in a safe asset, an asset that people go to as a safe haven in gold, that had such a tremendous run before this conflict that it's not a place to hide right now, and it's making it difficult to as an investor have any place to hide. And really, the only place that we're seeing people hide is in short-term treasuries, in T-bills. Other than that, you're seeing assets jump around in price wildly, whether it's gold or silver or stocks or Mag sevens, or it's or even treasuries. These things are moving around wildly, and so there has been no place to go to kind of navigate this uncertainty. And as you said, uncertainty. Uncertainty is it's definitely the word of the year so far. And markets hate uncertainty. They want resolution. And so until we get that, we're going to be in kind of a period of turmoil here. But looking at it as a whole, if you ask my philosophy and how I'm looking at this, and where I feel we're going, is what I fear we're going is to a place that I experienced when I was a kid, when in the 1970s and 80s, when we had stagflation here. And of course, that was exacerbated by the Middle Eastern conflict back then. And so you had a rise in energy prices and oil prices, a spike in oil prices, a spike in gasoline prices. You had, rationing of gasoline. If you were here in the United States as a kid, as a little hockey player, as a kid, I was missing hockey games and practices every other week because we just couldn't get gas. It was literally the end of your license plate. If it had an odd number, you were in the first and third weeks of the month, and if it was an even number, you were in the second and fourth weeks. And so, if we couldn't get gas, then we would just wait. And when you could, you'd sit in line for hours and hours. So these things are in people's minds. That The 1970s and 1980s, that they're in investors' mind. And so as they approach this market, they're worried about that. And you could see it. You can see that they're very worried about a spike of inflation as we head into a possible downturn in the economy. And if that happens, we're going to have the 1970s, 1980s all over again, except this time it will be worse. And the reason for that is because we have tremendous fiscal dominance right now. We're running record deficits. And not only do we have $39 trillion of debt, but our debt to GDP is over 120%, as opposed to near 30% back in the 1980s. So this is a really tumultuous period. But that number is key to the outlook for America, the Fed, and the Treasury.
Lavish highlights a critical issue facing the U.S. economy: unsustainable debt levels. U.S. debt exceeds $39 trillion. Debt to GDP ratio is over on 20%. This creates a dangerous cycle. 1. The government must borrow more money. 2. Higher interest rates increase borrowing costs. 3. Deficits grow even larger. 4. More money printing becomes inevitable. Because of this, Lavish firmly rejects the idea that central banks will stop printing money. In his words, they have no choice. This is a key pillar of his Bitcoin thesis. If fiat currency continues to lose value due to inflation, scarce assets like Bitcoin become increasingly valuable.
Well, what you're seeing is a spike in oil prices almost daily from tweets. You know, they react like the market reacts to the whims of 140 characters, and so that in and of itself means that the market is uneasy. And so when you see gold sell down 10%, 20%, that's a signal that the investors are concerned. They're concerned that they're going to need cash. Why would they need cash? Well, they need cash because they are concerned they would get a margin call. And so when you see things like Bitcoin drop 10, 20% over a weekend, well, that, although it hasn't dropped 20% over the weekend, but 5 or 10% over the weekend on a Sunday, that's chiefly because investment managers are repositioning themselves. Hedge fund managers are gathering cash just in case there's a downdraft in the market on a Monday morning. They need cash. They need to be set up in case they get margin calls on especially on stocks. And so when you have moves like that, it just shows that there's a great amount of uncertainty in the market. So I do believe there's still uncertainty in the market, and the fact that oil is jumping around the way it does, that's just a clear indication of that. First of all, QE, quantitative easing, is when the Fed goes and buys the treasuries, okay? Buys the US treasuries. And why would they do that? Well, what they do is the treasury basically, in effect, the treasury presses a button, money it just appears on the Fed balance sheet. The Fed then turns around and has banks go and buy treasuries for them. They bought treasuries and they bought mortgage-backed securities back in 2008 and in 2020. Okay, why would they do that? Well, they do that because what it does is it adds money into the market that wasn't there before. Okay, so suddenly new money shows up and it's buying assets in the market, and that what the new money wasn't there before. So it's kind of like if you're playing Monopoly, right? And we all have our positions on the board, and then suddenly the bank says, you know what, we're just going to dump more cash on the board. Here's more cash for you, and more cash for you, but not more cash for you and not more cash for you. But these two people who got cash turn around, these two banks turn around, they're like, oh, well, I'm going to go and buy Park Place. I'm going to go buy Boardwalk, and, I'm going to raise my prices. I'm going to buy some hotels and put that. So there's more money in the game now. Okay. So, and that money starts moving around. And so if you think about it in terms of the the Fed is trying to make sure that the bond market stays stable and liquid. And when you have periods of disruption like you did back in 2008, in 2019 like I just described, in 2020 when you had the lockdowns, then what they do is the Treasury and the Fed team up and they add money to the system. So that's the money printer that everybody talks about. And so, but why is that important? It's mostly important because what happens is when you add money to the system, it primarily goes into buying assets, whether it's buying the treasury bonds that we just talked about, or that additional money gets used to uh, for debt, for large buyers, for asset buyers, for stock buyers, for buyers of gold, for buyers of other assets like houses, businesses, of Bitcoin. Like all of these go up in price, and it causes inflation, and that inflation is a secondary effect from all of this, but it's directly correlated to the money printing. So if you look at the expansion of the money supply, it's expanded at somewhere north of 7% year over year since 1971. And so that expansion is what's causing all of these asset prices to go up, whether it's stocks or it's gold or it's houses or it's Bitcoin since, later, since 2015, maybe after it started really getting more mainstream. But that's what we talk about when we talk about the uh, the necessity, the importance of owning assets in periods like this. So going back to your original question is, what is my thesis? What is my macro outlook? Well, my macro outlook is right now, I have uncertainty just like everybody else, but I do find comfort in the goals of the administration and what they're trying to do. And on the other side of it, no matter what happens, because we have so much debt, and like you just asked, we have so much debt in this country, and we have to keep servicing that debt. We're running multi-trillion-dollar deficits, meaning that we're spending more money than we take in on taxes, meaning we have to borrow every single dollar that we spend there. On every single deficit dollar, we have to borrow more, meaning we have to issue more debt. So when you ask, why is it so important for the 10-year treasury to not be over 5%? Because it forces the US Treasury to borrow only on the short end and keep kicking the can down the road, knowing that eventually they're going to have to start borrowing at longer terms, meaning they're going to have to start borrowing at 7 years, 10 years, 20 years, 30 years, because the buyers demand that at some point. And so you can't have yields that are too high. Why does that matter? Because when you have yields that are too high, then the treasury is forced to pay higher interest rates on that debt, which means that those deficits grow even more, which means they have to borrow even more. That's the problem ultimately. Yeah, so that's right. I that's exactly how I feel. So I'm optimistic that we're not going to head into a period of 5, 10 years of stagflation like we did back when I was a kid. I don't think that that's going to happen. I think we're going to resolve this. I think we did learn our lesson there, and we don't want to do that again. And so I think that this gets resolved, and ultimately, like you said, that means that we're going to have an exacerbation of the expansion of the money supply, which means that you need to own assets. And that's what I keep telling my readers, my listeners. That's how we invest. And assets like gold and Bitcoin are essential to every portfolio, in my opinion, both of them. I happen to like Bitcoin quite a bit. I have a high degree of confidence in Bitcoin, and primarily my holdings are in Bitcoin. And so that's where I believe that you're going to find not just safety, but you're going to outpace most of the markets if you're in Bitcoin rather than just gold or just stocks. And but the reason that that's important for outpacing is because of what you just said. The inflation across all other goods and services is going to increase, and so asset owners are going to do okay. It's the wage earners that I worry about, and that's why anybody who's a wage earner and is not invested, you need to be invested long term. These periods of uncertainty are terrible, and it's difficult to navigate. But if there is a market downturn, I believe it would be a chance of a lifetime to buy assets on sale and get the benefit of the money printing that will occur, just like we saw in the great financial crisis and in 2020. It's going to be the same playbook all over again. It's just going to be more than before.
To summarize, James Lavish presents a clear and structured worldview. Bitcoin is fundamentally different from other cryptocurrencies. Macro forces, especially debt and money printing, favor scarce assets. Market volatility is driven by uncertainty, not weakness. Future monetary expansion is inevitable. In this environment, Bitcoin is not just a speculative trade, it is emerging as a core financial asset for the digital age. While short-term volatility remains unavoidable, Lavish's long-term outlook is unmistakably bullish. He sees Bitcoin as a once-in-a-generation opportunity, an asset positioned to thrive in a world where traditional monetary systems are under increasing strain. For investors and observers alike, the message is clear. Understand the macro landscape, recognize the structural shifts underway, and position accordingly. Because in the end, this isn't just about Bitcoin, it's about the future of money itself.